Okay, welcome back. In regards to home mortgage, there are three examples, so I like to read them. The Tremblins owned a home. They paid $1.5 million for the home mortgage many years ago. On January 31st of 2022, the mortgage on the home was $700,000, and the value of their home was $1.7 million. And the term line refinanced their mortgage. The new mortgage now is $1.3 million. The term lines did not use any of the loan proceeds to improve their home. Okay, that's the issue, right? If you don't use that loan to improve your home, it's not deductible. Interest paid on $700,000 of new loan is deductible as acquisition debt. Some of the interest paid on the rest of the debt would qualify as home equity debt in a year in which the law permits this deduction, which we're going to look at it later on. Any interest paid on the excess borrowed that is not home equity debt is non-deductible personal interest. Got it? So you will have a client, they're going to come to you and say, hey, here is the interest that I paid, but you have to know how much is the loan balance. So right now for balance of the loan that you can deduct is up to $750,000 right now. If the loan was established before December of 2017, then the balance is $1 million threshold. But right now, any loan that came up starting 2018, it is $750,000 max. Same fact on example 14, except that the term liens used $120,000 of loan proceeds to remodel their kitchen. Okay, now we are talking. So now we have $120,000 of this loan used for improvement. The term liens can deduct interest on $750,000. Why? Because that's the threshold I just said, right? $750,000. And why is $750,000? Watch, the loan is in 2022. So it's after December of 2017. So it is $750,000 now. Yes, the original acquisition debt is $700,000 plus $120,000, which is $820,000, but it is limited to $750,000 no matter what. Make sense? Okay, same fact on example 15, except that in addition to using $120,000 to improve their home, the term liens spent $200,000 to buy a second home. The term liens can deduct interest on $750,000 of the mortgage as acquisition debt. Interest on the excess debt is not deductible unless the second home is a security for the debt. So if you have a second home, secure that home as a security of that debt, and you can deduct up to $750,000 again. For each home, you can have up to $750,000 acquisition debt. So you can have up to 2 homes, right? 1 home plus the second home. The second home can be also your motor home, your RV, or a boat with a kitchen. That will be considered as second home. Okay, home equity debt is a little bit tricky now. It says for the tax year 2018 through 2025, after that Job Act of 2018. A taxpayer may not claim an itemized deduction for mortgage interest paid or accrued on any home equity debt on any qualified residence unless it is used to buy, build, or substantially improve a qualified residence. So if you got that equity debt right now, which you use for buying, building, or improving your residence, then you still can deduct that interest on up to $100,000. However, for taxable years beginning after 2025, this deduction may be allowed again, and you can have an equity, home equity line of credit borrowing and having the deduction, even if you didn't use for improvement. But up to 2025, between 2018 and 2025, you can do that. And such a debt, it says, plus the balance of the acquisition debt cannot exceed the fair market value of the home. Continuing with example 16, $300,000 of $1.3 million mortgage that did not count as acquisition debt qualifies as a home equity debt. However, the code prohibits Tremblay's deduction of interest on $100,000 of such a debt after 2017. Therefore, they will not be allowed to deduct interest related to $750 of their debt. They will be allowed to deduct only for $750 of their home mortgage interest on Schedule A. Once the Tremblay's loan balance falls below $750, the interest deduction will not be limited anymore. So the loan maximum is $750 that you can deduct. Okay, let's put another good example, I think. In 2004, Hoffman bought a home for $600,000 and took $400,000 acquisition debt. Okay, $400,000 mortgage. By February of 2022, the loan had a balance of $180,000. Okay, so far so good, right? And fair market value of the home was $1 million. The Hoffman took out a second mortgage of $20,000 and used the money to buy a car and take a trip. Okay, that's the problem. Buying a car and taking a trip is not qualified right now. Since this money was not used to improve the home, it falls under rules of home equity debt, and it will not be deductible between 2018 and 2025. On August 2022, Hoffman decided to add a pool and a patio, which cost $25,000. The builder financed the work. The property secures the builder's loan along with the other loans. So it's a secondary loan. So this loan is to finance improvement to Hoffman main home, qualifies as acquisition debt because it's used for improvement. Interest on this loan is $1,000 for 2022. Okay, now you have a client, Hoffman. He comes to you. He says, I have all this, interest showing. Total interest associated with their house payment is $18,800, which is $17,000 on acquisition debt, $800 on home equity debt, and $1,000 on home improvement debt. Up to year 2025, this $800,000 will not be qualified up to 2025. So the only thing is qualified right now is this $17,000 acquisition debt and $1,000 interest that they paid because of home improvement loan. So the Hoffman deducts only $18,000 on home mortgage interest. So how much you're gonna put in Schedule A? $18,000. That's it. So your client comes with all these papers. You have to choose which one goes in, which one does not. There is a possibility that someone puts the whole $18,800 in Schedule A, right? And nothing happens. That's fine until you get caught. If you don't get caught, then God bless. If you get caught, then those are things that might happen, and they gonna investigate and choose what will be included, what will not, and you have to pay penalty and interest on those things that you put in there without authorization. Mortgage insurance premium. Okay, let's read that. Before it was mortgage insurance premium a deductible item. For a limited period, homeowners who pay mortgage insurance premium. Do you know what is mortgage insurance premium? MIP, mortgage insurance premium? No one knows? Okay. If you don't know something, then ask me. If I don't know, it's okay. I will Google it for you. But at least we will figure out. Okay. Mortgage insurance premium is this. When you want to buy a home, technically you are required to put 20% down payment. If you don't put 20% and you put, let's say, 5%, then you have to buy a separate insurance policy on a monthly basis to pay for it. That says, in case you cannot pay the mortgage and you want to get, lose that house, and bank's gonna go after your house, and your house gonna be sold, and it cannot cover the loan, that insurance premium policy will cover the portion that you didn't pay, the 20%. Remember, you have to put 20% down, right? So the insurance premium will cover that rest of the amount that you need to put as a down payment, but you never did. Now, that whole mortgage insurance premium can treat those payments as interest for a period of time, right? But not anymore. However, this deduction is limited to persons whose AGI does not exceed what? $100,000. And the next thing, when AGI exceeds this limit, the taxpayer must reduce the deduction by 10% for each $1,000 in excess of AGI. In addition, the mortgage must have been issued after 2006. This rule expires after 2021, and now we are trying to learn 2022 tax returns, right? So for 2022 tax returns, this doesn't exist anymore. Here says unless Congress reinstated, but Congress didn't reinstate it. So for 2022, it's not available anymore. Are we good? Okay. Reporting home mortgage interest. Most taxpayers who have mortgage receive from their lender Form 1098. That's normally what happens. Mortgage interest statement will be received by your clients. They will bring it to you, and you need to also know what is the loan balance. Again, remember that $750,000 limitation? This form reports to taxpayers the amount of mortgage interest paid during the year. Mortgage interest reported on Form 1098 is shown on a different line on Schedule A. From any home mortgage interest paid during the year, not reported on Form 10. So if it's not reported on 1098, there's another line on Schedule A. You want to see it? Should be there. Schedule A. Here, line 88, that's Form 1098, goes in line 88. If it's not reported on 1098 and it is a loan from a person or something like that, then you have to put it in 8B. and you have to make a line item in your software. Line item, name it, what institution, what person, something like that. The reason IRS wants that, do you know why? Because IRS wants to know who got this interest income. So IRS goes after that person and asks for income tax. So if you got this from Mr. Joe, so you need to put Mr. Joe and his social security number in that line item, so IRS knows, go after Joe and say, hey, Joe, looks like you got interest income because of this loan. Okay, so we are good, hopefully. Ask me questions if anything. Yes?
Wait, you got interest income? Isn't the insurance premium an expense?
We are not talking about insurance premium. We are talking about mortgage interest. If you borrow money from someone private as a mortgage interest, and you recognize it as a mortgage interest in your tax return, IRS wants to know, okay, this is the expense. IRS says, okay, I take that. But who is the lender? Lender is Mr. Joe, right? Let's say, because Mr. Joe didn't give you 1098, remember? So that's what 1098, if it is 1098, is good because IRS has a copy of it and knows who got the income. Yeah. Because an expense for you is an income for someone, right? So IRS wants to know who is the receiver of it. Points. Let me explain what points is. Let's say you want to get a mortgage and they offer you 6% or pay, let's say, $10,000 right now and you get 5% mortgage interest. So you can reduce your interest rate by 1 point and instead pay something right now in advance. So that's something that you pay in advance. You call it, I paid points. That means I paid prepaid interest. Because you calculate, you say, okay, if I use 6% in 30 years mortgage, I end up paying a lot of money. So it's better to pay $10,000 right now and bring the point 1 point lower from 6% interest rate to 5% interest rate. And that will be much more beneficial for me as a borrower. And this prepaid interest that you paid, let's say that $10,000, IRS says, okay, that's a prepaid interest. Are you accrual basis of taxpayer or are you cash payer of taxpayer, cash payer method, cash method? If normally most people are cash method. So it says somewhere, of course, that has to follow a few rules. Here you see it says number 1, points on borrowed money is an established business practice in the area. The amount charged does not exceed the amount usually charged in the area. Funds to pay the points must come from borrower's own money, $10,000 from your own pocket, not from the lender's fund. Make sense? Who's paying for that point? You, yourself, from your own checking account. That's a point. That's a prepaid interest. If that is the situation and you are a cash method of taxpayer, then you can deduct it, all of it. But if you are accrual method of taxpayer, you have to amortize this point, $10,000, for the next 30 years and recognize it piece by piece as a form of amortization of prepaid interest. Make sense? So here says, as a rule, taxpayer deduct prepaid expenses over the periods to which they apply, which is, let's say, in a 30-year mortgage, you amortize it in 30 years. But somewhere, I'm sure it says that you can deduct it. Here, this special rule only applies to cash basis taxpayers who take out loan to buy or improve their home mortgage. So they can deduct that in when?
In the year they.
In the year they pay. They can deduct in the year they pay. Like I did pay points for mortgage, but when I received my I think 1098 in the first year, it shows that you have paid points. How much? Let's say $5,000, whatever. So I deducted it right away, and that was because I was cash method of taxpayer. Most people are cash method. Here says a special situation. A special situation arises when the property is sold or the loan is refinanced. If the property is sold, any unamortized, not yet deducted points are deducted in the year of sale. Make sense? Those are small things that you really need to know. There are a lot of things here that you never use it maybe, but there are things that it is common. If the loan is refinanced, so the house is not sold, just loan is refinanced, then the unamortized points plus any new points paid with the refinancing, let's say you paid points again, are deducted over the life of new loan. Again, unless you are a cash method of taxpayer, which is majority of us, we will deduct that as a mortgage interest on the first year. You know, under cash method of accounting, you recognize expense when you pay for it. You recognize revenue when you get paid. That's the whole idea. However, if a part of the proceeds from refinancing main home are used to improve the home, cash basis taxpayer can deduct a portion of the points in the year paid. So there's an example here. In 2020, Kerry, cash basis taxpayer, took out a mortgage to buy his home. In 2022, which is 2 years later, Kerry refinanced his mortgage with a 30-year, $150,000 loan. To get a lower interest rate, he paid 3 points. So 3% of 150 is 4,500. 2 points, 3,000 were for prepaid interest. 1 point, which is 1,500, was charged for services provided by the lender. The payment of point is an established practice in the area. The 2% charged is not more than the amount typically charged for points. So far, so good, right? Kerry's first payment on the new loan was due on May of 2022. Since the proceeds from the new loan were not used to buy or improve his main home, Kerry's cannot deduct all of the points in 2022. Instead, he deducts $3,000 evenly over the life of the loan. The $1,500 for the other 1 point cannot be deducted because it was for what? It was for services provided. You see that? In 2022, Kerry's deduction is $67, which is $3,000 divided by 360 months for 30 years mortgage times 8 months made in 2022. So why she cannot deduct all of this $3,000 immediately? Because this is a refinancing, and since the proceeds from the new loan were not used to buy or improve the mortgage. So it was just a refinancing. Make sense? But if you first time you pay points to buy your home or do improvement on your home, and you are a cash basis taxpayer, yes, you can deduct all of it. But she's not in that category, so she has to amortize it. Okay, we amortized the $3,000. We got it. Can you tell me where is this $1,500 going? Where is that going? $1,500, anyone? Your client is paying $1,500 over there, is asking you, where do you put it? That $1,500 plus escrow fees, you pay for escrow fees too, right? All those will be added to the basis of your home. Make sense? When you buy a home, you pay something for it, right? So you have a basis. Then you sell it maybe one day. Then you compare your basis with your selling price and you figure out what is the capital gain, right? Out of that capital gain, up to $500,000 for merit finding jointly will be excluded from capital gain. Assuming you have been in that home for 2 years during the last 5 years, then you can deduct that. But bottom line, you want to have higher base. If you have higher base, you have lower capital gain when you sell it. Make sense? So this $1,500 is not going to get wasted, but it's going to be added to your basis. That's the tricky part of it. So if you have an expense for something, either you expense it like a point, if you are a cash basis taxpayer, or you amortize it for the life of mortgage. If none of this happens, like this $1,500 situation, then it will be added to your base. Okay, investment interest in general, if you borrow money to invest and then you have income, obviously investment interest will be also a deductible item because you are generating money, right? So an individual itemized deduction is allowed a limited deduction for interest on loans used to purchase or hold certain investment property. Investment interest include interest paid on a loan to buy or hold on to a taxable investment, which includes stock, bonds, vacant land, gemstones, artwork, anything that will be considered as investment. The tax law does not allow deduction for expenses related to non-taxable income. Therefore, interest paid on amounts borrowed to buy or hold onto non-taxable investment like municipal bonds is not deductible. So you cannot deduct, you cannot borrow money, pay interest expense, and then invest in municipal bond. Why? Because municipal bonds, state bonds, government bonds, college bonds, municipality bonds, those are not federal, interest income is not taxable for federal government. So federal government says if you borrow money for those things, you cannot deduct it because it's not federally taxed. Some investments are considered passive investment. Okay, the tax law does not treat interest expense related to a passive investment as investment interest. This interest is deducted elsewhere on the tax return. For instance, interest expense on rental property, where do you deduct that? Rental property is a passive investment, right? So the interest expense on passive investment, like a rental property, belongs on Schedule E, which we talked about it last time. I remember there was a question about it. So rental investment, mortgage interest on rental, those type of thing goes on Schedule E. Limitations, let's see. It says there's an investment interest limitation, limit the deduction of investment interest to the amount of taxpayers' net investment income. That means, let's say your income is $1,000 of that investment, and then your interest expense is $1,100. So how much can you deduct on Schedule A? Just $1,000 up to your investment income. The extra $100 you carry forward. Any investment interest not deducted because of this limitation may be carried forward in future years. When carried to the next year, it acts just like what? Just like that interest. Just like that year's investment interest, and faces the same limitation. Investment income includes taxable interest, non-qualified dividend. So all of these are income. Okay, what is income? Income is what? Any income you have from taxable interest, qualified dividend, non-qualified dividend, and some royalties. It may also include qualified dividend and gain from sale of investment. Those are all income. So if you buy something, then you sell it, you have a gain, and because of that transaction, you borrow money and pay interest, that interest is deductible. Investment interest is deductible because you bought something and you sold it. And remember I said I was doing real estate? I was buying real estate and selling real estate. I was borrowing money, right? So that borrow money for that real estate, it is investment interest, which is deductible. Okay, so we got the idea. Okay, here is a long example. I suggest you read this when it's quiet time, so you can kind of see an example of it. I'm gonna skip that. Go to charity. For charity, again, you have normally you pay by cash or check, so you have kind of up to 250 is absolutely no problem. You can use it, but normally I suggest to have a receipt if it's more than 250. Deductible gifts, donations must be made to qualified charitable organizations. To deduct gifts to foreign countries, taxpayer must make the donation to qualified U.S. non-profit organization like Red Cross. Gifts may be cash, checks, or credit cards. When taxpayers use their card for charitable purpose, they may deduct actual car expense up to 14 cents per mile to go using your card for that charitable situation. Okay, this is an example. Neil paid $400 a plate for YMCA benefit and made a cash donation of $3,000 at the banquet. The YMCA's cost for dinner was $20 per person. Neil could have bought the same 2 meals at the bistro for $75. The charitable contribution deduction is $3,000 $725. The difference between the amount donated and the value of the dinner. So the dinner is $3,000 plus $800 meal. What is that? $400 a plate. So that's why it's 800.
Shouldn't it really be?
What was that?
I was thinking it should be 75 times 2, but it was 2 meals for 75.
Yeah, it says she could have paid for same 2 meals for 75. So donation is 3,000, which is okay. $800 of meal, which is here $400 times 2, minus $700 value that you can have it in a outside. The NIL do not take the YMCA's cost into account. The NIL enters $3,725 on the gifts by cash or check line in scheduling. Okay, so we got that part. This is a good example. It says Neil have a widow neighbor to whom they gave $200 each month for groceries as a help, right? For 4 months. Neil's gift to the widow are not deductible because widow is not a non-for-profit organization. So you can help people if you like, but it's not deductible. Qualifying charities are non-for-profit organizations that they have 501c3 status. Those are non-for-profit organizations. Balin donates $1,000 to his alma mater. His gift allows him to buy season ticket to the university's football and basketball game. The tax law treats zero as deductible because yes, you donated it, but it gives you a right to buy a ticket, something. So technically you are benefiting out of that. So it's not a donation. Special rule applies for donation of property that falls in either of 2 categories: ordinary income property, including property held for 1 year or less, or capital gain property held more than 1 year. So if you have a property and you hold it for less than a year, it's an ordinary income property. But if you keep it for longer than a year, you enter into long-term capital gain category, and that will be included in the capital gain property type of thing. Donation in both categories may include real estate, tangible personal property, like motorhome, boat, RVs, or tangible personal properties. Or intangible personal properties. Okay, so those are donations, non-cash. So normally you can deduct them, but there's a little bit of issue in regards to fair market value. Tangible personal properties consist of most tangible properties that the taxpayer owns that is not real estate. The usual item contributed under this category includes clothing, toys, furniture, appliances, books, which some of us do sometimes, right? To, let's say, Salvation Army. Normally, the fair market value of these items is less than the taxpayer's basis. The fair market value of household goods and clothing is the thrift shop or garage sale value. Blue book value is common source for valuing vehicles. The charity cannot determine the fair market value of donated items. So you have kind of to estimate what is the fair market value of those donated items. Let's say $300, $200, something like that. Intangible assets most commonly donated include stock, bonds, mutual funds. For the most part, these assets are widely, very important, widely traded. That means the fair market value is easy to determine. That is a very important subject in accounting and taxation. There are some people that they are working just in valuation section of a big corporation because they have a lot of assets, and there are people that are doing just valuation all day long based on easier the one that you can easily determine because of fair market value is determinable, but some of them is not. Then it's a long process on that. Generally, the deduction for non-cash gift is equal to fair market value of the property at the time of donation. This holds true when the fair market value is less than taxpayer's basis. Again, you know to know your basis, right? For every single asset you have. However, when the fair market value is greater than the basis, the amount of the deduction depends on whether the item takes the form of ordinary income property or long-term capital gain property, and how the charity used the property. So there are a few things that you need to consider which one you want to use. When the total deduction for the non-cash item exceeds $500, the donor provides information about each non-cash donation on Form 8283. That's why I said up to $500, we can just put it there, but if it goes above $500, it gets a little bit more.
Can you have multiple $500 donations, or is it once it goes over 500, it's got to go? Like,
No,
even
up
if
to
it's three
500.
different donations, each one is
Up to 500
total.
total. It's easy.
So that's what most people put in, 500.
For any non-cash donation, a receipt from the qualifying organization must specify how the organization used the property. So it's important to know the usage. So we're going to get examples on this hopefully. The taxpayer who donates vehicle to charity, then sells the vehicle, can only, charity gonna sell it, okay? And the sale price will be used. So the charity may incur penalties if it does not report the sales price to both the donor and IRS. So the charity has to report to you and to the IRS how much they sold. Meals make several non-cash donations during the year. Even though the amounts paid for the donated items were far greater than their value at the time of donations, the donations is limited to fair market value of the donated item. The Neils got receipt from the charity for each of their donations and used the documented thrift store value to arrive at $720 deduction. So you have to document it, fair market value, specifically if it is more than $500. Up to 500, something below 500, IRS will not bother you that much. Okay, let's look at this income example. Steve built a bookcase and donates it to the local high school. It got appraised for $800. But Steve paid how much? $120 for materials. So that's the only thing he can deduct. Doesn't matter if it get appraisal of $800 or whatever. Okay, capital gain property. The Neil donated shares of IBM stock to their church. They paid $2,000 for the stock many years ago. On the date of donation, the stock was worth $3,500. So it had a capital gain, right? The Neil's deduction for non-cash contribution totaled $4,220. $720 from example 24, which we covered that already, plus $3,000 fair market value of the stock. You see that stock right now, fair market value is $3,500, right? Since this amount exceeds 500, the Neil complete Form 8283 to provide details of their non-cash donation. They attach Form 8283 to their tax return and enter $4,003 145, which is 4,220 value of the share, plus $125 cost of bookcase. Remember that bookcase?
What happened to the 720?
That 720 includes 3,500 plus 720.
Oh, that's what the board.
4,220 is coming from. Plus the $125 gift book shelf material. Okay, so we have several examples here that I suggest read them one by one. Every one of them gives you an example. But one thing that I like to do, maybe one of them I know is really good. I don't remember which one. Okay, let's do this. Maybe one or two of those. I don't remember which one was really good. So Ray, an art collector, donates a painting worth $25,000 to local hospital. Okay. $25,000 is the fair market value, right? But Ray paid $3,000 for painting years ago. The painting is tangible personal property held long-term, which is long-term capital gain. Thus, it is capital gain property. However, since the hospital cannot use the painting in relation to its exempt purpose, which is treating patients, Ray's charitable deduction is limited to $3,000. So when you donate a painting, make sure donate to the right place. If you donate it to school, to let's say a museum, then you can deduct $25,000. But if you donate it to hospital, then your basis is just $3,000. That's what it is. Same example, if Ray donates the painting to a museum, there you go. Since the painting will be put in use in museum tax exempt purpose, Ray can deduct $25,000. That's the thing that I was trying to kind of emphasize. Same fact, example, except Ray purchased the painting 9 months earlier. Since the painting was not held for more than a year, if it had been sold, it would have produced short-term capital gain tax at Ray's regular ordinary tax rate. Therefore, the painting is ordinary income. The code limits the deduction of such a property to raise only $3,000 basis. Because he hold it for less than a year. All of a sudden, he has such a big capital, short-term capital gain. And IRS says, you want to donate it, that's fine, but your basis is just $3,000. That's what you're going to use. Same fact that the example 27, except the donated property was stock in a corporation instead of painting. Stock is intangible property, and Ray hold it for more than a year prior to donating it. So it's more than a year and it's intangible. Painting is tangible, but stock is intangible. Therefore, stock is capital gain property, and code allows Ray to deduct $25,000 fair market value. The same scenario, except the property donated was land held as an investment. The hospital used the land to expand its facilities. So that's a good thing, right? Since land is real property that Ray held it for more than 1 year, it is capital gain property, and Ray deducts $25,000 because hospital is using it for its purpose of, increasing hospital care. Same fact as example 27, except Ray paid $25,000 for painting, and the time it was donated, it was worth $3,000. So he paid $25,000, and now it's worth only $3,000. Since the painting declined in value, since Ray bought it, it is not capital gain appreciated property. The general rule allows Ray to deduct $3,000 for fair market value. So it doesn't matter how much he bought it. The fair market value was $3,000. So he has just to go with the fair market value. That's it.
As the IRS talked about NFTs,
NFT, what is that?
digital art, what is that?
Non
Fungible token,
non
fungible,
tangible, intangible,
fungible. I don't know.
fungible. I don't know what is it.
Digital art. Yeah. It was popular like in the last 2-3 years, and it was appraised for like such $1,000, but not that after like years kind of passed, like the value of the NFT is not that.
Honestly, I don't know. I never heard it. I don't know.
No, people just reported like.
Is it
thousands of dollars.
2-3 years old type of thing? New things?
Yeah,
It's a digital painting?
yeah. But people pay like thousands and thousands of dollars.
Yeah,
and not-
I don't know.
Oh,
I don't know. Okay, the limitation is just so you know is 60%, 30%, or 20%. There is a limitation on your charitable gift donation. For regular clients that you have, is normally 60%. If that's subject to AGI, 60% of AGI, 30% of AGI, or 20% of AGI. If the donation is bigger than 60% of AGI, the remaining donation will be carried forward up to, I think, 5 years. Okay, so here, the deduction for contribution of cash property to most organizations may never exceed 60% of AGI. But it says it's gonna become 50% after year 2025. So for now, it's still that 60% good. Now, this is the thing that it comes to 30%. The deduction for appreciated capital gain. So if you have a property that has appreciated, like the examples that we were looking, you bought it for 3,000, now it's 25,000 fair market value. So if you use the higher fair market value as a deduction, you cannot use more than 30% of AGI for your itemization. The rest will carry forward up to 5 years. But if you really like to avoid the 30% AGI limitation, you can use the basis. If you use the basis, you can go back to 60%. But if you like to, example that we said 30,000 basis, 25,000 fair market value. So if you donate that, you want to use 25,000, then only you are subject to 30% of AGI. The remaining goes for the next 5 years. If you like to use 60%, you have to use $30,000 basis. Remember, for the example we were using, 30,000 basis. That's what you have to use. Then you will be okay to use 60%. In order to do 20%, here, when taxpayers contribute capital gain property to certain private foundations not operating for benefits of public at large, the contribution is limited to 20%, which that's not that much common. So that's where the 20% comes. But overall, you are talking about what? Either 60% AGI limitation or 30% AGI limitation. I suggest to use fair market value and subject to 30% limitation of AGI, but at least you can use it for next 5 years. Make sense? But again, every situation is different. So you have to choose which one you want to go. You want to go with 60% option or 30% option of your AGI. Are we good so far? Okay, let's take a break. And then we come back for how to prepay taxes. Okay, so we are back. You can read the rest of this chapter 5, obviously. It has a lot of good examples that you can look at. But we are almost there, and we covered Schedule A as much as we could. I suggest going to Lincoln Learn certification.com and going to Practice Lab. That's where the software is, so you can practice all this stuff that we are learning. And you will have a quiz and fake scenarios so you can prepare tax returns. The initial password is this one, train pro web. And then you need to so-called use your username and password to log in. Okay, so I mean, this is the practice after that you go. We covered that already. And I told you that in order for you to learn the process, you have to start to go to practice return 1, 2, 3, 4, 5, 6, 7. Every one of those practice returns, if you click, you will see it. They have, I cannot practice it for you. You have to do that practice, okay? So it says practice exercise 1 Jackson, let's say, right? So you have the answer here, which is kind of says what is the AGI, what is the earned income tax credit, what is the refundable additional child tax credit, and what is the actual refund for the 1040, which is good, right? So it gives you some idea, and you can kind of look at this, but you need to know what is the scenario. So you go to attachment, and this is the practice scenario 1, and one of them is the tax return. Yeah, so one of them is the tax return. Let me click on this, see what's gonna happen. Okay, yeah, so this is the scenario. It says name, address, social security number, those type of things that you want to use. And this is a W-2 that they received, right? You need to enter those W-2G for whatever reason. That's gambling. They received it. Educator expense, $250. Right now, up to $250, we can deduct educator expense if it's K through 12 teacher. If both husband and wife, they are teachers, you can deduct up to $500, or married filing jointly. Daycare provider, you always need that. You have to ask your clients to provide you daycare provider information and the amount that they pay. And that's about it. So this is the technically information. So you can print this and then go back to practice lab and prepare the tax return. If you want to see the tax return itself, here is the tax return itself that you need to prepare, but you can compare it to this and learn to see if you did right or you did kind of differently. So this is the actual tax return that you can prepare in practice lab. All the W-2's information goes in the W-2. If there is anything that needs to be, crossed, you cross that state, enter the state information, and everything goes in this. So because of this W-2, you do not need to attach the W-2 to the tax return. Previously, when we were doing paper return, you need to attach the W-2, right? But nowadays, the software is producing the W-2 in the tax return. So you don't need to literally cut the W-2, the copy that goes to IRS and send it to IRS. So you don't need to do that. Here is the W-2G. Here is the disclosures to the tax preparer that normally they sign. And here is the e-file authorization that the client needs to sign the e-file authorization. So here it says how much is the refund for IRS federal government e-file authorization, and I authorize practice lab, blah, blah. Here put the signature so you can e-file it. Make sense? And here is the actual tax return that shows the tax return's name, social security, if they have a dependent, how much gross income they have, and there is $3,000 other income, looks like, from Schedule 1. And if you go down, you will see they have $250 in Schedule 1 as adjustments. That $250 is because of teacher, K through 12. And then we deduct standard deduction for married filing jointly, I believe. Is it married filing jointly or what? My eyes. Right there, head of household. And head of household, because we have one dependent. So that's why it's 21,000. Married filing jointly, it should be a little bit more than this. Maybe 24,000 something. Anyway, that's the taxable income, taxable income, 10% of that, because this is low income, so it will go with 10% the minimum, which is $788. And looks like they have W-2 withholding of $1,826. They have other forms, 300. I don't know what that is. 300 other forms. I don't know where is that coming from.
I think that's the law from the gambling. I think that's what I started in the beginning.
Oh, they have all gambling laws, but gambling laws goes in Schedule A, doesn't go in here. Should be something else. We will figure out. Earned income here, 4,291, which is earned income normally fully refundable, so it's fine. Additional child tax credit is 1,500 here. So child tax credit, you see, let's see. We have amount in Schedule 3 as an adjustment. You see amount in Schedule 3 as an adjustment. So we're not gonna use child tax credit here because we have other adjustments that it doesn't make it necessary to waste our tax credit, child tax credit in here. So instead of wasting child tax credit in here, we're gonna use additional child tax credit, which is $1,500. That's if you add them up, that's 10,000 plus 2,000 here, that's $12,000 refund. And you put the routing number, and that's the best way to do it. Always tell to your clients, direct deposit or direct withdraw is the best. And the rest is just, you can look at. So here in details, Schedule 1 is showing $300 additional income. That's $3,000 additional income, which is good. That goes in Schedule 1. And Schedule 1 shows in page Schedule 1.
8.
Here, 3,000, line 8. Okay. So the reason I'm doing this right now, I want you also to do it. when you prepare taxes, make sure you go over the tax return to see if it makes sense or not. So I know where the 3,000 is, that makes sense. Educator expense, that's $250 that I knew what it is in 1040. I already guessing that's in Schedule 1 as a form of adjustment for a teacher. So we have that 250, but that's good. Additional credits and payments, credit for child and dependent care, that's why we get 788. So since we get that 788, we're not gonna use child tax credit, wasting it for no reason. So we're gonna just use this credit for dependent care. And dependent care is one person, up to $3,000, one person. If it's two child or more, $6,000. Other payments and refundable credits, what is that? Net premium tax credit. Net premium tax credit, we kind of covered that. If you pay, normally when you want to apply for health insurance through Covered California, based on your income that you estimate you might have, they will pay a portion of your health insurance, and you just pay small amount. You might say that I don't want you to help me. I want to pay from my pocket. You can choose that, and then in return, you get the whole amount that you really deserve as a help, as a refund. Make sense what it means? So it's not something that you say, oh, I lost it. No, you're not going to lose it. Either you use it, or if you don't use it, they will give it to you. But in some situations, if your income later on ends up to be high, and you told them, I make just a little bit money, but they gave me, but now you have a lot of money in the form of revenue and income. So the government says, wait a moment, we gave you too much health insurance help. Now you have to pay back. So you have to literally pay to the IRS whatever they pay you too much. So in this case, they are getting credit, net premium tax credit. Itemized deduction we learned today, it's a Schedule A. I don't think it's gonna be used, but still the software is producing for you, because you have the option to click the box and force to use it, but normally you don't want to do that. It shows that you have some general sales tax. You see 564, that's the calculation of general sales tax for you, for your client, based on the income they have and the number of dependents they have. But it's gonna be unused. It's gonna be just there for decoration. Child and dependent care expense, that's the form that you need to fill up. They spent $3,100, but how much will be the limit anyway? Just $3,000. Okay, so based on that, multiply with the percentage, depends where you are as a as a form of income, and then you choose the 20, let's say 7%, which is coming from probably that age. Which is 29,000. Do you see that? Okay, that will be done automatically. That's $788 and it is 810, but they use 788 because that's all you owe. It's not refundable, by the way, right? Remember, it was just 1 year refundable. I think that was in 2020 because of COVID, but not in partially refundable. Earned income credit. Okay, earned income credit, that's the form, schedule EIC. And here is do we have two child or one child? Oh, son and brother. Oh, there's a brother also. But anyway, looks like one of them is qualified, I think. I don't know the scenario. So. Here is the calculation for qualifying children and other dependents. So here is the AGI looks like. We have $2,000 number of qualifying children under age 17 for the child tax credit. So under 17, we have one only, which is just $2,000. And the limitation is for head of household is 200,000 threshold, which we are not there. So it's $2,000 is the amount of line 8 more than line 11 is 2,000, yes. And number of qualified under 17, number 1 multiplied by 1,500, enter the result is 0, stop here. So that's why we got $1,500 for child tax, additional child tax credit. Additional child tax credit is refundable portion of the child's tax credit. The child tax credit overall is $2,000, yes, as you see here, right? But out of these $2,000, only a portion of it will be legally refundable. We call it additional child tax credit. Refundable portion out of these 2,000 is only 1,500. And that's why you get $1,500. Here is credit for qualifying retirement saving accounts. That's just $2,000. But I don't know if they get anything. I don't think they're getting any. Showing blank here. Yeah, I don't remember if we got anything. And number 2, credit for qualifying retirement saving contribution. Smaller of line 10 or 11. Line 11 is 0. That's why smaller is 0. So they're not going to get anything. Here is the saving bonds that it was in the scenario that they want to put money in the partial portion of the refund in the saving bond. Here is the form for it. Premium tax credit, it was the health insurance that they buy from Covered California, and based on AGI and some calculation. These numbers, your client get a form, 1095, I believe, that these numbers are in the form, and because they are same, you just enter one of them. But there's a box says, if these numbers are not equal, check this box and enter manually. But if it is same, you just enter one of them and in each column, and it will populate itself. And it will do the calculation for you. Here is the calculation. And you will see how much you will have as a form of qualification for the any either refund or if you owe. If you owe, it goes in part 3. It says repayment of excess advance payment of premium tax credit. And you will have sometimes clients that they have this situation, they have to pay back. Okay, so that's about it. The rest are just worksheets and extra stuff, earned income line, earned income credit calculation, and those types. So those are all things that you, bottom line, you're gonna verify. So now let's go. Kick me out. Okay, so bottom line, I want you to practice this, right? This is, the tax return is given, answers are given, everything is there, but you need to practice so you get used to this process. We were watching this last time, return preparation number 1, as a form of learning it. That's me. It covered up to some portion, I remember. So I want to stop it right now here. You see, this person is preparing taxes based on the scenario that is provided, right? So would you like to go ahead and practice and prepare that Jackson tax return?
Yeah.
Yes?
So this is our next assignment, we have to prepare something.
Yes, so I want you to make sure that I can answer any questions that we have. You can definitely watch this at home, right? But I want you to go inside and start preparing taxes for at least 10-15 minutes. So get you going. And again, it will be saved. So if you are not finished with it, that's fine. Save and exit, and then tomorrow you can continue. Make sense? So I'm gonna hold on to this because we watched this already. We learned how to start. You can watch the rest of it. It will be useful, but it's better to use our time. So I'm gonna go to practice return number 1. Go to that attachment. Do I have it? Yes, here. So I'm gonna print this and give it to you. Do I have papers? Normally, no. And then I want you to prepare taxes in the practice lab, okay?
So we have to log into our own.
Yes. So I'm gonna stop recording at this point, and because you are working on your own right now.